So if you are, trading the US dollar against the Canadian dollar right now by just staring at the price of oil, you're honestly looking in the wrong place.
Yeah, absolutely. That is a completely outdated playbook.
Right, which is why for this deep dive, we're treating USD CAD not as some simple commodity proxy, but as a full-on structural campaign,
Mhm.
one that's driven by regime shifts, underlying incentives, and, actual liquidity flows.
Exactly. Because price is ultimately just a reflection of deeper structural incentives.
Yeah.
And right now, the core incentive driving everything is this massive asymmetry in monetary policy constraints.
Like the Fed versus the Bank of Canada, right?
Right. I mean, the Federal Reserve is maintaining a restrictive stance, and the crucial part is they actually have the structural ability to sustain it. The Bank of Canada, on the other hand, operates under these severe domestic constraints.
Yeah, they just cannot afford to match that posture. It's like watching two marathon runners. The Fed is pacing comfortably, holding their stride, but the Bank of Canada is running with the weighted vest of consumer debt.
That is a perfect way to put it.
But wait, let me actually push back on that for a second. Why is Canada's vest so much heavier? Because, the US has plenty of consumer debt too.
Well, it really comes down to the plumbing, specifically the mechanics of the housing market. So in the U.S., homeowners are mostly locked into 30-year fixed mortgages.
Right, so they don't really feel the rate hikes immediately.
Exactly. They are largely insulated from current rate hikes. But in Canada, the standard is a 5-year mortgage renewal.
Oh, wow. So they have no choice but to absorb the new rates.
Yeah, so that means every single year, a massive chunk of Canadian households are forced to refinance at current punitive rates.
Ah, so that deeply rate-sensitive housing sector, that's the weighted vest.
That's the vest.
Us.
And because of it, the Bank of Canada will be forced to tap out of restrictive policy long before the Fed. If they don't, they risk triggering significant domestic fallout.
So that policy divergence basically forces the Bank of Canada's hand, which naturally dictates where global capital is going to gravitate.
Exactly. U.S. markets just perpetually pull in capital because of deep liquidity and a distinct yield advantage.
But what about, Canada's traditional shield? Doesn't a stable oil market usually protect the CAD and bring in flows?
Usually, yes. But stable oil right now doesn't generate the massive incremental inflows needed to offset that persistent structural demand for U.S. dollars.
Right. It's just not enough volume to fight the macro tide.
No, it's not. And furthermore, you have to look at our current mixed risk regime. Like when uncertainty hits, you get these immediate safe haven flows rushing straight to the U.S. dollar.
And when we get a risk-on environment,
The Canadian dollar only gets a modest temporary bump. So across almost all environments right now, the structural bias heavily favors the U.S. dollar.
okay, but if this structural advantage is so obvious to everyone, isn't the trade crowded? Like if
Yeah.
you are managing a book right now and mapping this out, how do you actually position yourself without just recklessly chasing the top of the market?
Well, that is the execution challenge. You have to exercise calculated patience,
Meaning what exactly?
meaning a structural campaign requires a methodical approach, not aggressive momentum trading. You build your positioning gradually by fading temporary Canadian dollar strength.
Oh, I see. Essentially using the noise to your advantage. Finding those fleeting moments where the CAD looks strong just to get a better price on the US dollar?
Precisely. You use short-term oil rallies or maybe brief risk-on phases as your entry points. That allows you to accumulate USD exposure aligned with the broader macro structure.
Rather than just blindly reacting to a daily chart.
Exactly.
Which really brings us to what matters next. Because, no macro campaign is permanent. If allocators need to constantly monitor for regime shifts, what actually breaks this thesis?
So we are watching for a few specific invalidation triggers. First would be a sustained hawkish shift from the Bank of Canada that actively challenges the rate differential.
Which we just established is highly unlikely given the housing market.
Right. Second would be a prolonged, really aggressive oil rally that drives massive new capital into Canada.
What about the Fed, though? The market is always trying to price in Fed cuts. If they aggressively pivot dovish, doesn't this entire U.S. yield advantage just collapse?
Oh, a dramatic dovish pivot by the Fed would absolutely erode the yield advantage and invalidate the thesis.
Makes sense?
Similarly, a broad global rotation out of the U.S. dollar into higher beta currencies, meaning more volatile, riskier currencies, would weaken the foundation of this campaign. But currently, the data just doesn't support those conditions being in place.
So as you evaluate your own portfolio allocations today, ask yourself, are you aligned with the heavy underlying liquidity flows, Or are you just reacting to the short-term noise of a commodity chart? And consider this. If the Canadian housing market is the weighted vest forcing their central bank's hand, what happens when other rate-sensitive economies around the world hit their own refinancing walls?
That is the real question to ponder.
Right. The US dollar's structural dominance might not just be a North American story. It could be the defining global theme of the next cycle.